Let's understand more. We have Mr. Rajan Venkatesh, the MD and CEO, and Mr. Harshvardhan Goenka, the ED of Strategy and Business Development at the company. Good morning, gentlemen. Good to see you all in. Well, we've looked at your ambitious plans, but the start to the year actually has been quite subdued. So in the near term, that's for FY25, what kind of a growth number should we work with? And what are the margins? Last few years, I can see the revenue number has been more or less flattish, and margins have been in that vicinity of close to 9 to around 11%. So give us a near-term guidance. We understand the 2028 vision, which we'll get into.
Right. So namaskaram. It's a pleasure that I've been able to join this first time for me. And thanks for having Laxmi in this platform. So let's just take a step back, right? When you spoke about our previous year performance, the one thing we have done exceedingly well is while the building blocks, that is acetic acid and others, which skyrocketed during the COVID period, actually have moderated down. And that's where you see our revenues being flattish, but this is actually backed up by volume growth. In the last financial year, we delivered 20% year-on-year volume growth from our business verticals, primarily essentials. And this was done on the back of continued operational excellence. And that is what we will also charter the journey into this full year, because the efforts we started last year will pay out on this full year basis. In Q1 specifically, we had also had the scheduled turnaround in our essentials business, and that's a large volume business. That's why you saw quarter on quarter, our volumes were down by 7% on essentials. And that is also something we have called out. But our specialty business with the product portfolio differentiation continues to drive profitable growth for us. So as we are also chugging towards this financial year, our ambition remains that we will deliver profitable growth and profitable volume growth, both on the volume level and also at the EBITDA level. That remains our focus. But I think you can respect that giving numbers specifically is something we are steering clear of at this point in time.
Okay, we take that note. Essential segment, there was a shutdown, so that's why volumes impacted. So
Absolutely.
Since you're focusing more on volumes than on revenues, tell us what is the volume growth for the year that we should work with in both the segments. Give us at least a band.
So again, just to keep it in perspective, it's not only volume, it's always in the essentials part, it's a lean and reliable business. So you trigger by two elements. One is volumes. That's why you look at asset bases and sweating those asset bases. And then you look at specific margins. So we steer by both levers, neither either one or the other. Right? And that's why last year we delivered 20% year-on-year volume growth for essentials. And the ambition remains again to deliver not the 20%, but a strong volume growth also year-on-year in FY25. That remains the focus.
So would 20 become 25 this year?
No, I think if you have done the entire operational excellence journey, you can only squeeze out so much. I wish we can, but no, certainly that's not the thing, because you can only have efficient plants one time around. But incremental capex and incremental is what we will certainly continue to deliver.
Interesting. Now, I wanted to ask you about your export markets as well, and I'd like Harshvardhan to come in on this one. How is the demand panning out over there on ground within the export markets for the first quarter? It was almost 2/3 of your revenue. Now, how does this mix shape up going into the rest of the FY25 as well? Does it remain as it is, or will there be a change, or you see more of domestic demand coming in for the rest of the 3 quarters?
Sure. Well, thanks for having us, Nigel and Hormaz. So on the export markets and Indian markets, I think Laxmi has been both 70-30 sort of mix, with the majority share being domestic. But given the entire headwinds in the entire European landscape, we've had to move volumes to other markets, and a lot of that has come in actually in India. So we've managed to move volumes in India, and I'm primarily referring to our essential segment right now, which we will see continue over here. Europe will continue to face headwinds as far as our own outlook is concerned. On the specialties, it's more of a balanced view. We are evenly split between our international and domestic markets, and we see that mix to broadly continue for the rest of the year.
All right, let's focus on a couple of other aspects. Fluorochemicals, that's a very small segment. FY26, what is the revenue number we expect from this segment?
So first and foremost, the focus in FY24 was to get mechanical completion of all our assets. This was a project that was delayed from our lens. So that was the primary focus. So we will see revenues from that asset already coming into play in this financial year, second half of this financial year. And I think we have already laid it out there in a 3-year period is when we focus on the peak revenues from that asset base.
Okay. Well, could you give us a number?
No, I would like to be a bit shy of giving numbers, but we will certainly make this very transparent. We have given the peak revenues. We have said peak revenues from that asset base is 200 crores. That will be achieved by the FY27 period, and we will start ramping up in this financial year second half. Hope that helps.
Okay, got it. All right. So you're talking about doubling your revenue. So my guess is that by 2028, your revenues will be in that vicinity of around 5,600 crores, right?
Yes. Yes.
And what would the margins look like, give and take everything at that point of time? What is the targeted margins? In the past, you've done 12-13% as well. So I ask you.
Yeah.
Right. So maybe Harsh, you want to take that? Yeah.
Yeah. No, I think our ambition as we laid out was about 1,100 crores of capex, split evenly between the essentials and specialties. We'd also become very clear with what do both of these businesses and how do we drive them financially. For every dollar invested in the essentials, we will expect an asset turn 3 to 5 and an EBITDA margin between 8 and 12. The specialty part, given it's more capital intensive, will give us an asset turn between 1 and 2, but EBITDA margins would be higher, and given the specialty focus, will be between 20 to 25. So that is how we will split both businesses, which will then eventually lead to the 2.7 to 3 times of EBITDA overall. And the balance, however, given the capexes are evenly split, will broadly remain the same in terms of revenue.
So margins go up to around 13 to 14% since it's going to be more on the value accretive side?
Correct. Correct.
Yes.
That's the range in which we will be.
13-14% is what we work with, right?
Yes. Yes.
Right. And since you spoke of capex, I want to ask you, what does that do to the debt picture on your books currently? What is the current debt that you guys have? And once you execute your capex plans, what does that do to your debt? And is there a timeline by which you will reach peak debt and then start tapering down from there?
So debt on our books is very, very limited. You've seen our financial statements. We have raised a QIP in the course of last financial year of 259 crores. Cash flow from operations remained very robust. We had a very strong cash flow from operations in the last financial year. So I think these are the levers which will keep us in good stead. Our board is very adamant that we should not over leverage. And so we can go up to 0.4, but I think we will do this only very prudently.
So you'll remain debt free by the end of this capex?
That remains a core focus.
And final question, ROCE, it is only at around 10%. You all see it moving up by 2028?
Yeah, our ambition is that in the past, as our capexes play out, we've actually delivered a 20% ROCE. And given our product mix and improved profitability, we expect to come back to that level.
All right, gentlemen, thanks a lot for joining in. I'll tell you what, the street has been waiting for some kind of delivery. Last few years have had its share of challenges. For 2028, you all are giving very ambitious numbers, and we're going to hold you all to these numbers. Doubling of revenues, margin moving through 13 to 14%, and ROCE at 20%. Let's see how you'll go about it. Thanks a lot for joining in here on Chartbusters.